Looks like it's going. Hi, everybody. My name's Trevor. I'm with Market Delta, and this is our third webinar with Rob with Discovery Trading Group. And this one is entitled Reading Order Flow Using the Footprint Chart. I know there's been a lot of interest in this. We're real excited to hear what he has to say. It is being recorded and will be later posted up to our blog, as well as you should get an email, I believe tomorrow, with a link that you can download this. That's what I'm recommending. Just download it so that you always have a copy in case it gets moved around on the website or anything like that. And other than that, I'm going to turn it over to Rob. He'll present. There'll be time for questions. You can just type those in throughout, and mainly at the end. Mainly at the end is when there'll be Q&A. And then I'll wrap up with a conclusion. We expect to go about an hour and a half or so today. So with that said, Rob, go ahead and take over.
Okay. Thanks, everybody, again, for coming back. This has kind of been a long haul, 3 weeks in a row, I guess it's been. And I realize it's a lot of information, but hopefully we'll be able to tie it all together for you today. Just a couple things. I want to briefly just touch on who we are again, because there's been a little confusion with a few things, number one, and number two, there may be some people that are seeing this webinar that didn't see the other ones. So we're a proprietary group in terms of the stuff that's focused on the blog, the ES trading. We've seen a couple of posts go up on some forums and stuff that have referred to us as hedge fund guys was one, and institutional traders in kind of the wrong context. And I just wanted to set a couple of things straight. We own a proprietary algorithmic research and development firm. It's a really big part of our business. We build proprietary multi-market trend following and mean reversion models for hedge funds and institutions. Those are our clients, and some overlay strategies for big equity managers and things like that. Our discretionary trading, which is, again, the purpose of the blog and obviously the focus of these webinars, is done in proprietary accounts. We do have a relationship with another private broker-dealer firm where we have a joint back office with a couple major investment banks, and we are, I'll just say we're involved in some things regarding offshore funds. But I just want to set that straight, obviously, for regulatory reasons and things like that, so that we don't have any confusion. So I guess what I wanted to do was kind of, I guess it's a recap from webinar number 2, just to kind of go over the trading process again, so everybody kind of can get it in the perspective that it needs to be. I mean, order flow is a really powerful thing, as you'll see when we get into this stuff, but we like to focus on the big picture. I mean, you have to get your edge from a lot of different places, and making sure that you understand that every part of the process is equally important. There is no, one favorite or this is better than the other, and you really have to rely on all of them to come together. So briefly, again, and also anybody who is coming into this webinar and hasn't seen the other ones, I strongly suggest for you to definitely, see those, digest them, because a lot of this stuff is going to be foreign unless you see how it's going to fit together. So obviously, the first step is identifying the raw rejection acceptance areas, as we call them, which is areas that are either lightly traded volume-wise or heavily traded. The second part is which possibly might be the most important part, is to handicap these areas for what you think their success or failure is going to be for them to hold. This is the thing, and we were talking about it again today, NJ and I, but this is one of the areas that a lot of people really fall short, because the mechanized mindset wants you to sort of forget about this and will it away and imagine that you never have to use discretion to be successful. And I'm not going to recap all that stuff again, but obviously this is really important. You're going to win any trade, order flow analysis or not, if you're right. I mean, you've got to be right about the level holding if you're going to fade and move to that level like we do, or if you're a breakout trader and you want to trade the breakout past the level, you better be pretty sure that it's going to, fail, and that's that's where all of your fundamental and macro and multi-market stuff and correlative markets and market internals and all these things come together for you to make those decisions. We call it handicapping or deciding what the probability of the setup is going to be. So that's really, really important. And again, a lot of that stuff is talked about in the second webinar. Number 3, obviously, we've got our plan before the day. We know exactly the levels we're going to look at. We've got a hypothesis about what we think our success is going to be around these levels and which ones we think are just kind of going to be a little volatility, scalping opportunities, and ones that we're really going to try to make a commitment to a quote-unquote real trade. So at that point, we've got our plan. We'll wait for the cash market to open. We'll wait for price to approach the trade area, and that's the point where we're using the order flow, which in the old days used to be the dome and reading the tape. And now we're using the footprint chart, obviously, which is far superior in every way because of the historic information, and you don't have to remember all the stuff that's coming through the tape. And it's really just it's just a huge, huge help. We're really addicted to it at this point. So what I wanted to do before we really get into the setups is just talk a little bit about the market delta footprint chart. And again, everybody's got their own setups, and I don't I don't want to have it be too specific to our particular use of the footprint chart. I mean, you can find your own ways to use this. Let me just open one of these here. Just a couple things to point out. The focus of what we're going to talk about is really related to the structure of the footprint itself. We do use the footprint bar statistics, which is this, the footprint price statistics, which is this stuff over here on the right. But particularly in relation to the volume profile, all of our decisions for our trades are being based on previous profiles for these levels and not today. So, however, we are watching this to see how it's developing. So if we're in a trade and we see that an area has developed that is either a particularly strong acceptance or rejection area, we might use that to modify our target in the trade. Similarly, the way that we use the buy volume and sell volume and the ticks over here, we do have our reasons for using these, but we'll just call that the advanced class, which I think is going to be a little bit beyond this particular webinar. Suffice it to say that we're using the price statistics to use it in the same way that we would with the dome and the tape, of gauging the speed and the quality of the prints when you're coming into an area. Obviously, what we want to see is a change from larger order sizes into smaller ones, and for a certain setup that we call the trap setup, we want to see things really start to slow down, and that's what we're going to use that stuff for. In terms of the specifics of the footprint itself, and just a couple things on the chart, if you guys want to get our particular chart definitions, you can. They're on ChartHub. You can import the defs and then use them yourself. You might not like the colors or whatever, but obviously you can change that stuff. Of course, I'm assuming that everybody understands that this footprint that we're using is the bid-ask footprint. So obviously what we're looking at is the bid volume on the left and the volume at the offer. Obviously this is aggressive prints, market orders that are either hitting the bids or hitting the offers. We're fond of this particular view, which only paints the dominant side of each price level. That's important to us because we like to see the shift, and it's a lot easier to see the shift when you see it go from being one color on one side and then shifting to the other as that becomes dominant. A couple other things, obviously, we're plotting a few other things and using session statistics. We don't, I shouldn't say we, I don't plot our levels. I don't put horizontal lines of our levels when we're trading them. NJ does. I just put the overnight high, overnight low, yesterday's high, yesterday's low, and yesterday's close, which you can see some of them here. This dark gray line is the overnight high. And this purple boxes is the VWAP, which we use as I guess a filter, I should say. So that's pretty much the anatomy of the footprint chart as we use it. One really important thing to understand and to really get a handle on yourself is periodicity if you're going to use the footprint chart to read the order flow. I can't stress enough that it's important to remove time from your analysis. what I mean by that is 1-minute bars, 2-minute bars, 5-minute bars. For us, they don't work because what they're doing is they're uniformly and systematically chopping up the price behavior into something that, in order for you to analyze it, you have to look at a whole bunch of past bars to sort of sum up what you see. We use reversal bars, which are also called point and figure charts. For anybody that doesn't know, if you're using a 6 reversal, basically what that means is when price makes a new high, whenever it makes a new high or a new low, you don't get a new bar until it retraces by that number of ticks, and then it goes to a new bar. What this does for you when you read the order flow is it keeps everything in perspective. Like here, if the market's moving up and it isn't retracing, you're able to see that. That's typically trending activity, and so it's very easy for you to zone in on something and see what you're looking at, and also get a really good gauge of the relativity between the prices. And I'm going to talk about that a little bit more in a minute, the relativity of the shading and the prices, the colors. Just to explain down here, these are the footprint bar statistics. What I've done is, if you could see this bottom pane that I've got kind of shoved all the way down to the bottom and it's not plotting, this is another footprint chart with the same instrument, also the ES, that's plotting a footprint that is filtered by size. We change the size filter depending on volatility and also whether it's overnight or during the day. Typically our size filters are 50, 100, and 150 and 200. Typically 100 is going to be okay for the intraday session, 50 is okay for overnight, but as volume changes and volatility changes, sometimes we have to up those in order to get the picture that we're looking for. Mostly what we're interested in is the delta within the bar, and again, relativity of the colors and the volume. It's all about relativity. So getting back to this particular slide, one thing that I didn't talk about is the up versus down tick. When you select a bid-ask footprint, you can have it plot for either the ask or bid volume or up versus down tick volume on either side. Obviously, it's just a difference of whether the orders are hitting the bids and the offers or whether they're actually responding to the up versus the down tick. Really, really marginal difference between the two. And I'm not trying to sell it one way or another, to be honest with you, but we just, for whatever reason, we find that the up versus down tick lets us see the footprint in a way that's a little easier for us to see. We just feel like it draws the colors and everything. For whatever reason, for our setups, it's a little bit easier to look at and to determine when we have a setup. Obviously, we talked about the other stuff, the session stats, we plot, the pivots, we plot. We talked about the pivots, day session and 24-hour pivots in the second webinar. And obviously the VWAP, as we use as a filter sometimes, because price tends to respect it when we're in certain rotational patterns. Like today was a good day for the VWAP respecting price. Obviously, we talked about the bar statistics and the price statistics. In terms of the order flow fundamentals, this might be the most important slide of all for you guys not to kind of go off on a tangent when it comes to the footprint chart and order flow. It's said a lot, around the internet that the footprint chart is a little overwhelming. You see that said about Market Delta sometimes because it's so much information. And I think people just become overwhelmed and they don't really know what to do with all of it because it seems like it's so vast and they could never really get a handle on it. This is one of the reasons why you might be surprised to learn that for this particular webinar, we're going to be using stills as opposed to video, because the video really, if you focus on that too soon and you start to see all the complication of the little details of price moving around and colors changing and numbers changing, that's really what becomes overwhelming. And we think that it's really important initially to settle in on these fundamental things that you see all the time and what to focus on so that all the other stuff is noise. You don't need to be looking at it. So hopefully when you see the way that we kind of pick it apart, we don't spend time really staring at the footprint and obsessing on all of the little details. We feel like we came through the other side. We used to have to do that with the dome and the tape. We're like, we don't need to do it anymore, so why bother, right? So the first thing is numerical details. What I mean by numerical details is the individual numbers for the bid or the ask volume. would be one. You know, when we're talking about relativity between prices, if you're trying to look for failures or you're trying to look for exhaustion where stuff is building up, you know, volume's building up at a price and you're considering fading it, you know, you really just need to look at it in a general sense. I mean, is it relatively bigger? Now, I can't sit here and have a debate with you whether, you know, if you're printing 1,000 on the bid and then all of a sudden you print 220, whether that's a relatively smaller number. Maybe it's 25, you know, maybe it's 68. It's all going to be within the context of what you're seeing. So you kind of have to look at a snapshot, sort of the big picture, and then decide what relativity means to you, depending on, you know, the other factors. Like we said, it's not just the order flow. You're doing a whole lot of different things here. So you're analyzing a lot of information. So nothing's exact. Obviously, the volume is one thing, the relative volume, but also the shading. And the shading is obviously the footprint is shading those colors. So you might be one where you respond more to really darker colors, where you see that, you know, the relativity of the amount of activity at the bid is so much that you really want to pay attention to it. And I do suggest that you do that. The shading is very, very valuable. And obviously the price level itself, I mean, this sort of goes back to the second webinar, but, you know, you can't sort of, if price is coming down to a level, you don't want to be just totally obsessed with the fact that it's 57 or whatever, and you're going to fade 57. I mean, you know, and we say all the time in our pre-market commentary, I mean, it could be 57, it could be 56.5, it could be 58. Sometimes you never really know where it's going to stop. So what you're trying to do is just use a little common sense and know that the market doesn't know that that's the exact level, and it's going to probe and do its thing. And so you kind of have to relax a little bit and just sort of let it develop, and don't get too trigger happy, and just, you know, you'll see when we go through these setups. It's all about the common sense approach. And again, think about what you're doing. If you're fading these levels like we are, you know, it is all about rejection and exhaustion. I mean, if you're trying to only enter a trade as soon as you see that price, you know, behavior exhaust around your level, then that's what's really important. You want to see that evidence. If you're looking for rejection, like, you know, we can't print at those prices, then, you know, a nice low relative print is what you're looking for. So just kind of keep that in mind and let go of all the noise, right? One of the most important things for us is trading with the institutions. I mean, obviously we're big size traders, and we know that it's people who trade size that are moving the market ultimately. And again, not even us. I mean, we're not even close to what I'm talking about when I'm talking about size. We're talking about sustained pressure of people working positions, sometimes even as high as a swing in a position time frame. So these things are happening, and they are happening at intraday prices, obviously. So definitely something to keep in mind. And it doesn't have to be absolute. I mean, we're going to show you a few things that you can do with the footprint bar statistics to understand what's going on with institutions, obviously using size filters. But you know, it goes beyond that. You know, instead of just an absolute number, look at the progress of the numbers, where you started when you're considering looking to trade, and then where that is in relation to the broad market. Or maybe, you know, you even want to filter the broad market down so that you're not even looking at the broad market. You're looking at just institutions, and then maybe, you know, just retail traders trading under 10 lots or something. Okay. So what we're going to do here is show you a couple setups. Actually, there's three. But before I get into them, let me just give you the caveat here that there's really, we don't think of them as separate setups. We think of it as one thing, and this is back to this rejection exhaustion thing that we're trying to accomplish. We're just looking for that no matter what. So whatever it is that we can see that helps us achieve that objective, which is what are we trying to do, right? Price is coming down into a level. We've decided ahead of time that we think that we want to fade that level. We think it's going to hold. So we're looking for the best place to get in. And we're also looking that if there's anything that's coming up that is going to show us something that's maybe going to talk us out of it, that we're going to be, you know, we want to know about it ahead of time so that we can make an adjustment and obviously either not trade or maybe, you know, change our opinion about where we want to trade, right? So with that said, each one of the three setups is not really an individual setup, but they can all happen simultaneously sometimes, or sometimes we're only going to look at one of them, and as you'll see, sometimes we look at some more than others, and we like more than others. So with that said, I'm going to get into the first setup, which we call the mousetrap. You know, mice, small traders, this is the mousetrap. So this is the one we talk about a lot. We've called it the trap trade. We call it the market maker trade. We call it the stop run trade. This is the one that you guys are probably most interested in seeing. And again, I think you're going to be kind of amazed at how simple and obvious it is. And it's not something to really, you know, where there's a lot of gray area. It's very, very simple to see. The first thing is it's almost never the first push into a level. Usually the level's broken ahead of time, or it's something that happened overnight. Maybe it was tested once and then we come back in. And that's really the essence of the trap, is that it has to be a level that's already been drawing interest from retail traders, in the sense that they're thinking that, wow, maybe we're going to break out here and we can find a breakout opportunity. So that's the first part of it. The second part is that the component is that we want to see the highest volume in the bar shift to the lowest part of the bar. At least for a long setup. For a short setup, it would be just the opposite. So what we're looking for is the volume to shift to the lower part of the bar, and then we're looking for, you know, obviously the left side of the, in this case, would be the left side of the footprint. It's going to be colored, and what we're going to do is watch it get redder and redder and redder. You know, obviously that's the relative volume coming in, and we want to see that the overall volume, you know, within the whole bar is higher, not just on the bid side, but the whole bar at that price is higher. And then at the last minute, once we've determined that this trap has taken place, we're waiting for the buyers to come in on the long side. We're going to see that shift where we're going to turn gray, and then you know, we're going to get in there as soon as possible. And essentially what's happening there is we're creating panic, right? So what we're doing is, as soon as that shift takes place, you can almost feel the psychology. All of those people that traded at the bottom are coming in, and you know, and they're immediately starting to get a little upset. Let's just say so. This is the first example we'll show you. This is a classic mousetrap setup here. You can see that a little nomenclature. First of all, in the reversal bar setup, when we push down initially, this is the first test of the level, and then obviously we can't have this bar happen until we've had a reversal at 6 ticks, or in this case actually it's 4 because this was at lunchtime. But so we come down, we have a reversal, then we retest, then we have a reversal, then we test again, and this is where the mousetrap is. Okay, but if you look at the relative prices. See, we came down here, we're printing 1,600 and 1,000. 3,300 and 910. You see the relative prices, and then all of a sudden we're putting 700 and 300, right? So right up, there's the line, that dotted blue line. So when we come down here, as soon as we cross over, all of these people had an interest in trading this breakout. But look what happened. Even though they were pounding contracts into it, they couldn't get it to move. They just couldn't get it to move. So this is where, you know, where we look for our spot. We come in as soon as those buyers take over. We're piling in right at that spot or as close to it as we can, and you can see, you know, it's just going to run really, really fast from there because of the panic of all those people that realized that they were trapped short. And then you can see, actually, you can see right here, you see all these prints here, 1,600, 1,000, 683, 1013. That's a lot of the stops being blown out from here. Okay, so that's really the first example. Notice that the volume shifted to the bottom part of the bar, and then it built up. It just sucked up all that supply, and they were all thinking that they were going to auction it straight down like they did this time, but they weren't able to do it. Okay, so up and up we go. Here's another example. Same story. Always looks the same every time. It's really just so easy. So you don't have to worry about, you know, all the details of what happens. You just know what to look for. You're looking for this amazing relativity. 253 prints here. Nothing happening, but the next time on the test, people said, we think it's going to be a good breakout. They piled in. You can even see in the deltas, see the strong retail participation here. Obviously, the institutions participate a little bit here too, but they couldn't move it, and we failed here with a 71. And then see that the buyers didn't step right in here. It took a while up here. Now, keep in mind that we're showing you after the fact, but you have to understand that what's happening is, see this 742 here is gray? Well, it wasn't gray initially, and it wasn't 742. it was probably a lower price than this 331, but that's the takeover. You get that shift, and they just, everybody floods in, and that's how you kind of know what your entry is. But you got to feel it out. I mean, again, I'm going to keep stressing this as we go through each one of these setups. Why is this a great setup? Well, because of this great trap and all this stuff. Well, yeah, that helps, but what's really important is I could tell you that this 87 or 88 level was a really important level in the market. And, this is why you had a lot of interest here, and this is why people were interested in breaking out, and this is why it's a good setup for a contrarian, too. Somebody had to win. The contrarians won in this case, and this was the signal, the 2216, that the contrarians were likely to win, okay? So, again, volume, high volume, you can see the high volume is outlined by this black rectangle. High volume comes to the bottom of the bar, buyers step in, and obviously you have a full rotation, more than a full rotation of profit. And I'll show you one more. This one had even more activity. It got hit a bunch of times. And you could see all these little failures, 135, 26, 270, 43. And this is kind of the general line here in the sand that needed to be crossed. But this is, see, you have to be flexible here. It's never exact. You just have to look to see it's set up right. And if you're looking for this 5,091 price to be the price, well, that isn't it. I mean, either you get a huge relative thing happening with the total volume, or you don't. Now look at the difference here. Why is this 10,420 and this 8867 the key price? Well, look at the relative prices. I mean, this is a good price too, but it got more. You have to wait for it to exhaust. You have to see where that volume shifts. And in here, there was so much interest in the breakout that they were actually able to extend it a couple prices down. But we don't care, because what we're looking for is right here, this 88.99. Until we get that domination of buyers coming in, we don't care. It's just we're seeing that, wow, we've got some activity here. We definitely have a mousetrap setting up. Is it going to happen? Is it not going to happen? We're not in any hurry. We know that as soon as that comes in, we're going to make that value judgment instantly. And again, and I'm going to go into this more, but we can see here, this one is really good. This shows the classic pattern that you can see within the deltas. And again, you're not using these in the setup. I keep pointing them out, but I'm doing that to lay the groundwork, that what I said before, that all of these things end up combining together. I'm going to show you a setup specifically for the deltas in a minute. But again, notice what's happening here. How do you know that retail was chasing this breakout and the institutions weren't? Well, there's your evidence right there. 4,353 net negative deltas for the broad market, for everybody. And 100 lots and higher were net 1,369 to the positive in deltas by the time this bar closed. So it shows you right there that the institutional traders, big lot traders, whatever you want to call them, were not interested in trading this breakout on any real level. And what they were doing was, that's us. We're sitting waiting for the suckers to get trapped, and we're able to make money off their psychology. And you can see here, look at all of these stop outs in relative volume. And the reason I'm pointing those out to you is look at the rest of the relative volume other than where we set up for the trap and we get that exhaustion. Look, 3,400, 3,900, 1,200, 946, we're trending down. Even go back here to these, 42, 3, 13, 17, 14, 9, 700, 1,100, 700, 1,600. That's kind of the pace of this time. I mean, it's like 6, 7, 8 o'clock in the morning that we pulled these charts. And again, I mean, I'm not, excuse me that there's no levels on here or anything else, but I'm trying to pull the examples so that you know what to look for. So it's for your own good, believe me. I wish that I could find them all without spending days, looking back for perfect setups between 9:30 and 10:30, which is when we trade. But unfortunately, I had to make some compromises. But again, you get the picture. But anyway, like I was saying, all of these relative prints here are sort of small. And then look over here, 5,000, 3,000, 4,000, 3,000. Everything got bigger, and the reason is because you have both. Initiative buying there of people saying, wow, okay, the market's moving up now, we want to get long, and all the people bailing out and covering, that don't want to be short anymore because they're trapped short, right? So you can kind of see that pattern set up too, where you see a lot of volume that is built up there. You kind of know that it played out in the way that you want it to. So again, just as a recap, if you have evidence that the institutions are not selling into the the trap, as we call it, then that's great if you have that. It's not a requisite because it's going to be so powerful when that happens, because obviously the broad market is so much bigger than institutions. The 100 lots is usually going to account for 10% of the total volume or less, no matter what the time of day is. So you don't have to worry about them really overwhelming the market. However, enough people watch them and are interested in what they're doing that even with relatively small amount of volume, bigger trade sizes are able to move the market. So that's the essence of the mousetrap. Okay, and obviously we got plenty of room for questions when we get back to this. The next setup we call little prints, and it's pretty creative, right? I'm sure you're dying to know what that means. It means just what it says, right? It's where you have a relative print size at the edges of the bars, which are, really small relative to everything else, right? So it's sort of like a price action setup. It's sort of like a double top or a bottom or a failure where you have a high failure like you did price action, or sometimes you have a probe through where you have your existing top and then you probe through, but you don't get the mouse. Relatively smaller, and the entry is still on the same thing. You're looking for that volume shift to come through. You guys got audio? People are saying, you got it? Okay, good. I just have to look up there. So yeah, the same setup before. Did you guys hear what I said about the little prints? Anybody?
Go ahead and repeat that, Rob. I think
yeah, okay.
That's been missed.
All right. The little prints are just what you think they are. They are, the price comes up to a level, either goes through it or doesn't go through it, and fails to print a lot of contracts. Again, you're looking for relativity, where you're not seeing a lot of prints relative to what the other previous high swing prices are. It could be a double top or a double bottom setup. It could be what we call a high failure, which is a price action setup, or a low failure where price comes into the level and doesn't actually hit the double top and fails a little bit under it or below it in the case of the opposite trade. Or it can go through it, but unlike the trap setup, it goes through it, but it doesn't build up that volume. It just does a straight rejection. Okay. So in the same way, you're going to enter in this on the volume shift. You're looking for that, to use. Hopefully, you guys will take our advice and use what we call the ladder view, where you're shading the dominant side, and then again seeing that shift over, where you get the color change and the price just above or just below, or as close as you can get to it. What we call the little prints on the top. One of the things that I have to stress about the little print setup is that you, unlike the trap setup, you really, 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 really need a belief that that level is going to hold. We trade little prints when we are really, really sure that we're confident in making a bet that the level is going to hold. So I guess the differentiation would be that on the trap trade, sure, I mean, we're trading it at key levels, but it's not so important that the level be right or the level be particularly powerful, because you have that psychology that's in there that's pulling on the trade. No level can outrun that trap setup. So, you could theoretically, you could trade the trap setup all the time if you wanted to, because, I mean, does it help when you're at key levels? Of course, but technically that psychology really pulls that through, because you have that fear. You have the traders getting trapped and they don't want to be there. It's uncomfortable, right? But the little prints, a different story. You've got to know that the level's going to hold, because otherwise what happens is the market can just shake off those little prints and crash through it. So you have to really be confident that the level's going to hold. So what I want to do is show you some good little prints examples here. Again, I'm going to reiterate again that when the price comes up to these key levels, just assume that this is a level. We don't have a line here, but obviously it's an important level. You can see this 1201, 1202 was an important price that we were trading at. This is back in 430. This is the classic little print setup right here. You see we come up, we make our first kind of push here, we rotate down, we rotate up, we print 1407 on the top. Rotate down, high price is 499. Rotate up, 374 on the top. Rotate down, 1624 on the top. Rotate up, 130 prints on the top. Just pure rejection compared to, and again, relatively speaking, is 130 small enough? Well, for whatever reason, I think it is based on this particular range of prices. But again, you can be the judge. I mean, if you only want to trade little prints that are more drastic than this, then you could do that. But for me, I'm going to gauge it really on the way I'm handicapping the level. If I feel that this level is really strong, and I'm saying, you know what, I really feel strongly about this. I want to get short here. I like it. I'm just going to wait for my setup. I'm not going to wait to only get a trap trade, because I got to tell you, the trap trades don't happen as often as you'd like them to really come up like textbook trades. So, I mean, it would be great if they did, because, the win rate is so high on those. But, these are too. So here's the classic setup. We fail with the 130, and it's right under it. You see that it immediately becomes overwhelmed by sellers. This number starts to grow. And obviously we're getting our entry, and you can see right after you get the entry, you see how this is moving really fast. 377, 547. Whenever you see small prints in the middle of the bar, that's indicative of the market moving faster. See bigger prints, it means it's slowing down because it's grinding. It's having a harder time getting through. So this distance from here on this bar, 82, where it says 82. I'm sorry I'm not using the prices, but it's so hard to look to the right here and see what they are. But if you're trading from this 82.43 bar, it's grinding through here. It's not flying through here. This is a lot of contracts. But, the distance from here to here is way faster over here. It's just ripping through there, and it's because the market is perceiving that failure. So a great setup. And again, this is something where you can combine the deltas for the whole bar, not the absolute numbers or waiting for the bar to close, but you can take a look at the relativity between the broad market and the institutions and see if they're changing. See, it doesn't really matter in this instance really what the absolute values are. What matters is at the point that this fails and it starts going down, are you seeing that you have the institutions agreeing that they don't want to be buying anymore? So at the very least, I would want this to just kind of freeze, and I don't want them trading against me anymore. So this number's staying relatively the same. And hopefully these guys are selling into it and just being really reactionary, because that's going to help your trade. Okay. So first little prints example. Here's the second one. Even more of a drastic failure, right? Look at the top prices: 1946, 2694, 738, 1379, 992. Then you rotate down, and on this down rotation, we print 52 on the top, right? Then we rotate up. I know it's hard for you guys to see, but these are reversals again. So this made a low. We go 1, 2, 3, 4, 5, 6, and then we print a new one here, and it prints nothing. Prints 11 contracts, and it just immediately starts coming down. Can you enter right on that 306 price? Probably not, but you see the point. And again, why are you trading this? Because you believe that this level is going to hold. You've already identified this level pre-market. You've handicapped it. You think it's a good level to short, so you short it. You're looking for the commitment down here too. Numbers are not changing very much, hopefully, or they're changing in your direction. And you can see here the huge participation by both the broad market and the large lot traders. Obviously, you see we trade that. Our stop in this case always would go on the outside of the swing up here somewhere, and you can see it called the turn perfectly, right? So sure you see that. It's pretty obvious. And again, these are, hopefully you're getting the message by now that half of you guys have market delta, and you're going, man, I've had market delta for a while, and this is all you guys do. What's the big deal about that? And it's like, this is what I've been trying to tell you, right? You think the big dog's got some secrets that you don't. They really aren't secrets. It's just common sense. If price isn't printing at a level, what do you think is going to happen? It's going to go down. In this case, it isn't. If you complicate your trading, it's going to give you all the handful that you want, and you're just going to hate it. So here again, we can go through this again: 225, 283, 45, 337, 212. and then finally you just get this drastic failure. Back to here, 45, against some of these other prices, 197, it's like not enough. So if you're wondering why I don't like that, I mean, that's an example for me. You could have traded there, and you still would have won the trade. Why do I not like it? I can't really tell you. It's just my perception of relativity. In that case, doesn't. For whatever reason, when I scan all of these prices, I'm seeing kind of everything. Well, where are we at? I'm seeing hundreds and twos and 38s and 172s and 134s, and I'm kind of seeing all of that. And 45 just isn't small enough in this case. So there's the trade. As soon as you get seller participation, you're getting in, and again, hopefully you're seeing that as this is happening. These are closed numbers, obviously. These don't show up and finalize until they close, but hopefully you're seeing that at the very least the institutions are moving in your direction, right? So hopefully you guys are seeing the message here with the little prints that you can combine this with the trap. In fact, one of the best traps in the world is the Mousetrap that also has a little print on the bottom. So you sell down, you cross under the key level that the Mousetrap happens, and then you have all of the volume coming in, and the number really starts to grow, and it turns really dark red or really dark gray. And then you also notice right at that time that it printed like 12 contracts on, right under where you had that swell of volume, and it printed, 5,000, 4,000 contracts. And that's the greatest thing that you can see, for the Mousetrap trade would be combined with the little prints where you got, 4,500 contracts of relative volume, and then right under it, it prints like 16. You're just going, yeah. So that's what you want to see. The last setup, and again, it's not really the setup, but it's one that you combine with all of these things and use as an alternative sometimes, is what we call big lots. I think there's a retail chain called that, so hopefully they won't litigate us. But this is what we call the institutional confirmation setup. Again, we like to trade with the big traders, like to trade with the institutions, and we kind of have a way to look at that, which is sort of extension of the little prints, and you'll see. As we said, it's a standalone or with a failure trade, which is the little prints. That's a failure trade. Same story, a retest or a failure of established level. And in this instance, we're really waiting it out and looking for strong institutional deltas on the retest. Obviously, the color gets really dark. One of the differences between when you might choose to employ what we call the big lot strategy as opposed to the little print strategy is where the little prints, we told you that you would like to trade them only when you feel really strongly about the level. A big lot's a nice alternative to when you're not really sure about the level. In fact, we had a couple of big lot trades today. Anybody who read our pre-market commentary today, I just was not feeling good about a lot of these levels, and I had a lot of things marked as scalps because I just didn't have confidence in those levels holding. And as it turns out, I was right. I mean, it blew through the first two, and it almost blew through the third one, and we did get a scalp off at all three. But then when it got to that 53 level, I just wasn't sure of it, and so therefore, unless I have a trap trade or unless I have a little, prints, I'm not going to trade unless I'm really, really sure of it. So the only thing I'm left with is this setup. So let me show you a example here. The big lot is sort of, I guess our most mechanical setup. Now I'm going to caution you guys and girls here. Like we say, I mean, don't mechanize this because it's not going to work. Don't start scrolling through charts and seeing this. When you do, you're going to see how accurate this is. This is just sort of whatever you call it, a version of a delta divergence setup, as market delta would call it. But you have to keep it in context. You're trading this at a level that you've identified to be an important level, and it's just a level that you know is really important, but maybe you're expecting that the volatility is going to be a little crazy, and you don't get things setting up, but you really know that you want to trade it. I mean, you have a good enough feeling about trading the level. You're just not really comfortable to get in early until you really have a good confirmation of direction and you're feeling good about it. So this is the alternative for that. Again, understand the footprint chart and the rotations. You're rotating down, you're coming into the general area of the level here, rotating up, rotating back down into the level, rotating up, rotating back down. This is how the reversal bars work, right? So what we're looking for here is any retest. It can't be in an upswing, okay? It can't, in this case, it can't be an up rotation. It has to be in a down rotation on a retest of, and a failure of whatever the lowest low is. You have to have that retest and a failure, which is coupled at some point by the time the bar closes with strong institutional participation, okay? And again, even better if you have retail participation, but the institutions are really what is going to drive this setup a lot, okay? And again, this is a good one too, because this is kind of a little print. There's a little print component in the bar as well, or close to it, so that kind of helps the setup. Now, there's a couple ways that you could trade this. You could either wait for the bar to close and see the, just see what the final tally is, and then you can either just get in as soon as this new bar opens, and I mean, I don't ever advocate using market orders, but you could use a limit, just limited ask or limited bid, just hit it and get in. Or you could do what we do sometimes, which is to actually, expect the new bar to actually rotate a little bit and then place a limit somewhere either one tick above or at the high volume area of the big lot bar, okay? And again, this is all kind of stuff that you have to feel out and get your own chops together when it comes to trading this stuff. But even if you just get in, you're going to find that this is a pretty accurate setup. However, it's an accurate setup. I'll say this with a caveat. It's an accurate setup if you're trading it at key levels, like we always say, and if you're creating a good risk model and a good money management model, and it suits everything you're doing, and your risk reward is favorable for the trade of whatever you think the target should be, and you don't have a lot of resistance overhead, and you have a reasonable place. So, it's if. It's a fantastic setup, but you can't let go of what we said in the beginning, which is, you've got to combine all your edges. You have to understand that they all mean something, and you can't just rely on this, which is essentially an indicator, is what we're giving you now. Hey, as soon as this is, whatever, then you get long or short, So try to keep it in context. But again, same story, rotates down. You don't really need the small print at the bottom, and you could either wait for it to close, get right in, set a limit, or you could actually get to where you get really good with this and do something that we do sometimes, which is to actually watch the progress of these develop while it's happening. And you just start to get a feel for it. You've rotated down, and it's just there's no more institutional selling. And even though it keeps banging on these prices, the only people that keep the shorting and putting prints into this 844 here are the broad market. And these guys are holding pat, or every so often you see this kind of tick up a little bit. So sometimes you can get in a little early. So that's the classic big lot setup, and again can be combined with other setups as well. Here's another great one. Market trends hard into a key level. I remember this level clearly. This 93.50. This is a great level for us. And obviously we rotate up, rotate down, rotate up again for this trade. Obviously, before this bar closes, well before this bar closes, we get strong institutional commitment. And look at the previous two bars. I mean, it was all buying. You could see. And then, they're just coming in and selling hard. And, you're just, again, you're making a bet. Don't ever forget that that's what you're doing. You're making a bet. You have to believe in it. I mean, with this confirmation, like I said, you can trade levels a little bit more loosely that you don't have to totally believe in. But, we still want to try to believe in them as much as we can. Or we'll sit on our hands. But if you're feeling good about this level, relatively good, you're feeling good about the pattern, it's really failed good, and you've got good institutional commitment, what do you care? You're not trading these levels because you're hoping that they're going to fall back down to 82 or something. You're just looking for a rotation if you're trading like us. We trade 1 to 2 points, and to be honest with you, most of our trades are 1.25. It's 1.5 typically. I don't even know what our average was last month. I think it was like 1.25 in the non-scalping account. So anyway, another classic big lot setup. Just waiting for that shift of selling to come in anytime after there. As soon as you feel comfortable, you could get in, or if you want to wait for the bar to close, that's fine. You can either get right in, let a limit come up and take you. You got to be careful. Sometimes you don't get hit. Stop on the other side of the swing, right? Pretty straightforward. And I'll show you one more. Just make sure you got it. Another one, really, this is a particularly strong one. Yeah, you come up into the level. Actually, you got some good failure up here too. Here, this was actually here. This is a mousetrap. If you guys notice, this is a mousetrap setup right here. See, we printed 25 on this high, and then we pushed past there. We went from 25 to printing 986 on the offer. You know, a lot of relative buying, but they couldn't push it. Sellers came in, boom, straight down. And of course, all we're doing here is, you know, if you miss the mousetrap setup, you get that next down rotation, the next up rotation, and by then everybody's committed. The institutions start selling too. Look at how dark these, both the broad market and the big traders selling it hard. And you know, pretty much a no-brainer. You know, you're going to get in anytime you see that strong selling commitment anywhere under the high price. So that's it in a nutshell. What I wanted to do was go through a couple examples of what I call putting it all together. And this is kind of just I just pulled a couple things, charts out of the market where you guys can see that you know, kind of how it happens in real life. I mean, obviously, I'm cherry picking these examples to show you the concepts, and I do want to reiterate that you need to keep it that simple. You know, you really got to resist the urge to turn this into something that's not. It's really just that simple. Just look for the big lot stuff. Just look for the little prints. Understand the relativity. Look for the relative colors. Look for the trap setup. Look for, you know, that relative volume swelling up and they can't advance it. You know, think about that as what that means when you have tons of contracts coming in and they can't advance it. You know, what's going to happen? Sooner or later, you know, everybody's going to freak out and start dumping their positions, and it's going to go the other way, right? So just kind of keep that common sense approach, and you'll do fine. So, you know, success, again, with all of this stuff is the combination of the edges, like we said in the beginning. You got the risk management, you got the capital management, you got identifying the price levels, you got handicapping the price levels, you got all your market internals, your macro stuff, you know, your stats, processing of volume, you know, calling guys, you know, interacting together on the blog, which I've been trying to get a lot of guys to do more now. And you know, all that stuff, talking to people. You know, we do it. We call. We have friends on the floor. We have, you know, just obviously a lot of people in our group. We got pretty long arms, but you know, we have clients that are, you know, really, really big, you know, institutional position traders, and we want to know everything about what everybody's doing all the time because knowledge is power. You know, obviously even the sentiment stuff. You know, I asked my dad. You know, knows nothing about investing, what he thinks about the markets. You know, and you know, he makes an effort to tell me. And you know what? That's the stuff that drives the market. It's guys like him adjusting his 401k or his, you know, whatever, you know, that are moving the markets in the cash market. So psychology obviously is a big part of it, and then you know, what we're talking about now, the order flow stuff. But let me just show you a couple sort of, you know, summaries here, so you can see it sort of all come together where you have a key price level and how you might interpret different things. Here we were coming into this this sort of 94, 95, 96 area that was a really volatile area that I remember trading some of this vaguely. They all kind of run together after a while, but kind of walk you through this price action coming in here. This obviously is a trend bar. Again, just to reiterate it, a nice thing about using point and figure charts is you have this this clean way to view the market. If the market's trending and you don't have any, you know, reversals, you just build one bar. And if the market's really choppy, you're going to have a lot of bars building themselves all the time. So here we trend down pretty hard. I mean, we're trending hard here. You know, trending a lot. People trading a lot of volume here. We come down, and you see initially we get this shift. We get this shift of high volume to the bottom of the bar. And initially, you might be thinking, wow, well, this is a pretty good setup. I mean, the relative volume's good. We've got what, you know, almost 1,500 or more than 1,500, 15,000 contracts rather that have traded, and you know, the relative price for these other bars is pretty good. You know, 1,700, 1,800, 2,000, you know, 3,000. You know, it's pretty good. So the relative volume's good. It's setting up good, but there's one fundamental problem with this, and why this doesn't qualify as a trap trade. And you guys can't see what's to the left. Not that it matters, because I'm going to tell you, it's because this level had not really been tested yet in recent enough times. I mean, if it happens overnight, it's valid, or if it happens, a couple hours ago or whatever, that's the stuff that you want to look for. But if it's basically a virgin level, there's not enough information for the trap. What you need for the trap is you need an establishment of a failure first, because otherwise you don't have retail. They don't know what they're trading. There's no breakout. They're looking. You need to have that level established so that they can see that, okay, this is the line in the sand, and we want to jump on the bandwagon and break out here. And then there's something for them to look back on and go, okay, here's the relative level I'm in, and then they go, oh no, I'm stuck. It's not going to go anywhere, and then that psychology kicks in. So that's what's wrong with this. Other than that, if this, let's say this was a key level, and we did break down, and this, let's say the level was right here, and it broke down, and the relative price here, the volume here was, it meets the setup requirements, and then you see these buyers step in here, this ordinarily would be a good mousetrap setup. This is the classic pattern that you want to see, where high volume and you see a massive flood of buyers coming in. Obviously, if you traded this, you would have got a little traction and eventually would have run out of steam. And so who knows? Maybe you get out even, maybe you don't. Maybe you get out with a little bit of loss, but the good thing about these traps is that they're going against you. There's no reason to lose, in most cases, your full stop loss point when you're trading a trap trade. They're just, you're going to win it right there on the psychology, or you're not. It's really cut and dry, so that's what makes them nice. So here we rotate up, we rotate back down again, and now you see this is all relative to this 590 level. We broke down. It took one more price to get there, as you can see, but it looks like this is setting up for a trap, right? We've got 8,000 contracts on the bid. We've got a total of 12,000. But what I don't really like about this is the relative volume underneath the price is not really quite big enough compared to the other prices. And I'm not just looking in this bar because we're trending pretty fast through here. We're skipping down here again. Remember, the low volumes are moving a little bit faster on the bid. But if you look at this, it's a little lackluster. 8,000 and 4,000. I mean, this is over 10,000 here. Then you look here, it's 7,000. I mean, it's here 14, 15,000. I mean, it isn't really that drastic of a price change. So, maybe, again, until you get good at it, you're going to get sucked into that deep shading there and go, oh, wow, that's great. This is a good setup. But you've got to look at all the prices in context and kind of get a sense of really you're looking for that drama. You really want to see that drama. So it's okay. I mean, you wouldn't hate it if you traded this. You'd probably make money. I mean, at least a couple ticks. You're going to blow through there. It's going to start to stall. I mean, you can kind of see within a point or so this is where all the stops are getting taken out. And it's fine. I mean, but, if you were trading for 2 points, it maybe wouldn't have been the best trade, or, I don't know. I mean, it's hard to say. But so that's how to perceive that. So again, just a little word of advice. Try to keep in mind the relative volume across all these prices, okay? So again, we rotate up again, we rotate down, and this time we get a better mousetrap. That's what it's saying, right? I just realized that until just now. So yeah, this is a better mousetrap. Here, you look at the relativity of the volume here. You get that really dark shading, 7,800. 4,000 and 4,000. So you got good relative volume down here compared to the rest of the bar. So it's really what you're looking for is anything under this 873 level. It kind of trends down a little bit, and then eventually it ran out of steam here. This is a little tougher to spot. This is why I held this for last. This is kind of an advanced one. It's a great trade, but you have to do the easy ones a little bit first until you really get comfortable with watching this develop and knowing that it's a mousetrap, because sometimes it's a little confusing because of the way the volume shifts around, and you don't really quite get it. But you'll get to where you can almost smell it. You can really see it, and you can really see the psychology in the speed and the quality of the prints as it develops. So, but again, look what happens. You get the strong buying come in, overwhelms this bar, and you can see here. You see these big numbers right here, 11,000, 5,700, all that. That's these guys as stops being blown out. So you have the initiative buying again, and then you just have a ton. Because look at how many there were. Instead of just one price, we've got all these, right? You got 8,000 and 8,000 and 6,000, 7,000, and that's That's what all there. So just those two prices, you had over 16,000, and look what was printed here. What a coincidence, right? 16,000. So you know, that's how you know that, you know, it's like, why do you think everybody traded that exact price? I'll tell you why. It's because that's those stops. And also notice, just as an aside, look at the strong institutional confirmation of this bar. You know, when this came up, I mean, this number was just flying. You know, this was like nothing. I mean, this bar 6 ticks and it built, and it just immediately just started skyrocketing as institutions just piled in and bought this. So even if you didn't catch the Mousetrap setup, you could have waited actually for this bar to close even and grabbed the big lot trade and caught this rotation from there. But, you know, and all the more power to it, you're going to have even more confidence to trade the big lot, even though it's not really a retest of the low. I mean, this is an up rotation. I mean, you could trade it here. You could call this a down rotation. You got strong institutional buying here too. So, you know, you go ahead and get long here and trade the big lot trade. I mean, point is, there's a lot of flexibility. You know, and you have to kind of, you know, read the whole picture at one time, and you'll start to get good at that, and you'll be well on your way. This one I like because, and I specifically did this because it had some losing trades on it, because I want you guys to see a little bit more the negative here, so you understand how this stuff plays out. So here we have that classic trending behavior again. You know, relatively small prints on the other side. We're trending down. Just keep hitting the bids, auctioning, 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 pushing it down, right? And the volume stays near the middle of the bar. That's a really good way to determine whether you're in a trending condition. See, the high volume is right in the middle of the bar. So we come down to this level just like a wall. We run into that. And usually you can tell when a level is really strong, actually, when you see that the rejection is a lot of contracts. It's like a line in the sand. I mean, in a way, it shows you how strong that level is when you have, you know, a huge number like 1,500 or 2,000, or sometimes you'll see. It just means that it doesn't have a chance to kind of bob around and then fail and you know, kind of like it's probing to figure out where it wants the failure point. It knew where the failure point. It knew exactly where it wanted to be. Bam! It's like hitting a wall. So you run into that. We rotate back up, and then we rotate down. So here you got the sort of a good little print setup here because the relativity is great. I mean, you got 50 on the bid instead of 240 and 1,500, right? So that's a nice kind of a failure test that could potentially give you a little print trade. Let's see if those of you who are paying attention can tell me why this isn't a good Mousetrap setup, right? Well, I'll tell you why. The reason it's not a good Mousetrap setup, even though you have all of this volume pouring in here and it looks like it is, it's not below the line, right? In order to have the Mousetrap, it's got to go below the line. You have to have that, you know, the line in the sand that everybody's interested in saying, well, we've trended this far, I think we're going to trend some more, so let me get in, right? That's a key component. If you don't have that, the level hasn't been tested in that sense, and so it isn't a Mousetrap setup, right? So, you know, is it an okay entry for a little print? Yeah. If you felt really good about the level and you're trading a little print there, you're supposed to trade there. I'm not going to tell you I wouldn't trade it. Maybe I did. I don't know. But I didn't win, right? We rotated up, came right down, we would have got stopped out. So, you know, no matter how good your analysis is, what's really great about this is it points out what I've been saying to you for 3 webinars, right? You're going to win if the level holds and you're right. You weren't right. You bet that the price was going to go up, and it didn't. It went down. You can't win no matter what your analysis is unless you're right. Okay? But if you do everything right, you're doing the best analysis, your risk model's good, you're going to find that you beat the market the majority of the time, and that's all you could be after, right? So rotate up again, rotate down. Now we've got to retest that level. We pushed down under that level, right? But we didn't have a trap set up. They weren't buying it. The suckers didn't take the bait, right? For whatever reason, they held it up. They didn't pound a bunch of contracts into it and then fail. It just kind of didn't do anything, right? So there's nothing, you know, nothing really going on there, but look what did happen there. 321 to the positive institutional buying deltas, so technically that's a big lot setup. You could wait for this bar to close and get long, and oops, sorry, no dice. Okay, so again, great analysis. You had institutions believing that this level is going to hold right here. It says so right here. You had 100 lots coming in. They're feeling good about it relative to the other prices, but not enough. You know, nothing really happened. You know, the majority was still selling, and the the way it happens sometimes. So, you know, this next level down here is obviously another level. It's not the same level. And again, I do remember these levels. This 93 was really important for a while, and this 89, 88, 89 level is really important. So now we come down here. We got a new level. We push down, and again, there's that marginal failure. You know, it's not a real, you know, tiny print at the bottom, and that's evidence that it's, again, a line in the sand. It's a really strong level. You know, the market's really going to respect that. You know, maybe it was hit way back here somewhere. I don't know. You know, but there's definitely a respect to this level. It's a really hard respect. We rotate back up, we rotate down, and now we get this this mousetrap. Now this one is a little different because it's spread across two prices here instead of just one. You know, it dipped down. They couldn't move it. They were printing just as much at the failure price as they were here. But you know, you can tell that it's the right setup. You buy the volume. You got good relative volume compared to the rest of the bars. I mean, it was kind of you know, printing very little on this rotation down. So you know, your relative volume for the rest of the bar is pretty good. And obviously the same thing sets up. You get your buying stepping in here. This price overwhelms, turns gray, and there's your long. So if you were trading all these levels, but you know, this is why we advocate really working on a risk and money management system that gets you trading a lot less. You guys know that in each one of our accounts, we only trade one trade a day, except for the scalp stuff. But there's a reason for that. We're doing it because we want to know exactly what our risk exposure is over a month's time, and we know pretty much exactly how many trades we're going to have or less. And you know, this is one of the reasons for it. That, you know, we accept the loss when we lose, and we don't get sucked into having a situation where we're just attempting to trade this. We trade it, we trade it, and we trade it. And now we've got two losses here to go with our win, and we're still net down. So, you know, hopefully, you know, you'll do what we do. You'll cherry pick what you think are the best opportunities to trade that you've decided on pre-market, and just look for, you know, just cherry pick. You know, look for the nuts, as they say in cards. You know, that's really what you want to be trading when you get the best of it. So, hopefully, this stuff has given you a simplistic view, and it's really making sense. I mean, hopefully what you're getting out of it is that the details are very rigid, and the little details don't matter. It's just these big details and understanding what the major concept is, understanding what the psychology is, and understanding that it's all about putting it together in context. And if you do that, I think you're really going to be successful. I mean, I can't imagine that you wouldn't be, as long as you don't complicate it. So. What I want to do, just for the benefit of some of the new people, is just reiterate a couple of things on the blog. We have a blog, for those of you who don't know, at discoverytradinggroup.com. It really started as a place for us to share amongst the traders in our group. We found that by doing a pre-market commentary and a post-trading analysis every day and sharing it with each other, along with developing a sheet where we share our levels and what we think are the best trade opportunities for the day amongst each other, that it has really been helpful for our trading in a huge way. And we had decided to make our stuff public just as a way to increase our accuracy and interest in doing those materials, knowing that there were more people looking at it, and hopefully, you know, by having a community to share and learn and be a part of it, enjoy the process. And it's been great. I mean, the official launch of the blog was really with the launch of the first webinar sponsored by Market Delta, and it's really been great working with those guys, and we've really enjoyed it. We have two you know, general sections. There's a whole bunch of educational stuff, and some of the stuff that we've talked about in all the webinars is here. I mean, we really don't see ourselves as educators per se, or, you know, and we obviously don't have a commercial site, so we're just you know, the content is just, it's whatever we can find the time to do, and that's the best we can do for you. But mostly the benefit is these two sections. We have a pre-market commentary and a post-trading analysis. In the pre-market commentary, we write down everything that we think are the important things to notice about the levels that we've developed in the pre-market sheet, which is here. If we think that a level's particularly weak or strong, or whether we're looking to fade it, or maybe we're looking to just scalp it and we're afraid that it might fail, or what we think the sentiment stuff is, what's pulling on the market, how the institutional pressures for volume are pushing and pulling, some macro stuff, anything that we hear from our people and from the floor and from bigger traders, or whatever we're processing for the day goes into here. So this commentary is probably the most important part of anything that's on the blog, I would suppose. And then we do this sheet which shows all of our potential trades for the day at the levels that we're looking at, and then obviously all the relative importance of every one of the levels, whether it's a rejection or acceptance. And again, anybody that doesn't know the stuff, it's all in the first and second webinar, and you can learn about all this stuff. We also do the footprint profile, which is where we develop our levels from. Again, first and second webinar, you can learn about all that stuff. And then we put it all together, and then after we're done for the day, we put all of the potential trading opportunities and trading opportunities. And again, a little disclaimer on that. Sometimes people would say, well, you only trade once in the account. How come you put 3 trades down? And again, this is very important to understand. What we're trying to do with this is to give you guys as many relevant examples of the way that we trade. So it isn't necessarily, when we put something on here, it isn't necessarily something that was traded in the main account, or it isn't necessarily, it could be something that we're just pointing out, and then in this writing here we're saying, oh, we highlighted a level that you should look at. So, don't get too hung up on our trading. We're not really trying to to make our own business really public with you guys in terms of exactly what we're, where we're trading and what level we're trading, and because it's impossible. I've got to mark this chart up every day with something that I think is going to be beneficial, that approximates what we were looking at and or what we did for the day. When you trade, you get fills at different places, you get slippage. So is it really that price, or is it this? And then we got fills here. On the exit, was it this, or did we give up a tick on some of the other exits? So it's too much information, and what I'm not going to do is go look at the trading logs and try to get everything perfect, because it doesn't matter. I'm just trying to show you the generality of our trading life in a nutshell. So please be understanding of that and respect that we're not, we're not trying to make this overly detailed in terms of our personal business. That said, all of this information is available, as most of you know, at the end of the day. We put both the pre-market commentary and the post-trading analysis available at the end of the day. What we're hoping is that once everybody gets a view of our webinars and sees really our whole method in a nutshell and how we trade, that they can put it all together and compare it with maybe what they're doing, and look at the levels that they were focused on, and then maybe reading the commentary and seeing that, oh, wow, those guys thought this about that level and I didn't, and maybe that's why I lost the trade, or maybe that's why they lost and I won because I knew something that they didn't, and then I can share that with them and whatever, right? So that's the general educational thing that we had intended, because we had no idea that we were going to get so much interest. And then we just got overwhelmed with people asking us to give the materials ahead of time. So as most of you know, we came up with a premium membership thing where we're giving the pre-market levels and all of our trading plan of the day to a limited number of people, which is limited to 50. I think there might be a couple of those premium memberships are left. I'm not sure. I have to ask NJ or the admin. And again, it's just it's getting, the only difference between what is on this blog, if you're a premium member and if you're not, is when you get it. If you want to have it pre-market, then you have to be a premium member. If you don't, then you just come at the end of the day and you use it for your learning and you study and you use your Market Delta playback and whatever to learn. So and hopefully interact with each other. Hopefully don't just ask us, ask the other traders that are in the community, and hopefully you guys are communicating and talking to each other. We do have a premium-only forum, because we're just inundated with people emailing us all the time, and honestly, we just, between the two prop companies and the algo firm, and we just don't have any time. And so we just made it so that we will mentor, I guess is the best word for it, the people who are the premium members. We'll discuss setups with them and the details of different things, but anybody else, don't get offended if we can't get to all the questions if you're not a premium member. And again, we're not a commercial site. I'm not trying to sell memberships. If anything, kind of just to the contrary, actually. we have an admin that can take care of most of that stuff, but the admin, what he can't do is take care of questions about trading specifics, and so we have to draw the line somewhere with what we can be overwhelmed with. Okay, so with that said, that is the blog. I think I've gone through all of that stuff, and you know, again, you know, put it all together, everything, the order flow, the levels, handicapping the levels, macro stuff, sentiment. When it's all together and you're deriving your edge from every little part, you will be trading as best as you can. There's no shortcut. I mean, I've been looking at these markets, you know, enough to drive myself insane since the 80s when I was an undergrad. And you know, because we're in the algo business, we know more than anybody. And if you don't listen to anything I say, listen to this. We crunch data for a living, and we've tried everything under the sun to mechanize intraday trading, and it is, without optimization, it is impossible to mechanize. It has to be constantly adjusted for volatility. If there's any edge, the ARBs find it and squash it out, and it has to constantly be redeveloped. You cannot find a mechanized way to trade intraday. You have to use discretion. If you've avoided using discretion and you're trying to will away that, you know, you've got to understand the macro impact of markets and bonds and money flow in the world and how that's going to impact you trading 1153, I'm sorry to disappoint you, but you're going to have to do it. I mean, you know, and if you can't get the info yourself or you need to learn, then learn from somebody, learn from us, get it from us, or talk to other traders and do so. And that's really the best advice I can give. I mean, we've done these 3 webinars. We've given you everything. I mean, I'm showing you, I'm not holding anything back. I mean, other than, like I said, the market internal stuff, the things that I can't even explain. Believe me, they're not that important. They're just my own little way of interpreting things. But we've given you everything. We're not holding anything back because there are no secrets. And even if everybody knew exactly what we were doing, which basically they do now, you know, you're not going to front run our trades or, you know, do whatever because you still don't know. I might change my mind at the last minute. You know, I'm giving you as much as I can with the understanding that you're going to always do it a little bit differently. Everybody is. So that's the best advice I can give, and I'll answer as many questions as you guys have. Or Trevor, if you have anything, we'll go from there.
Well, there's definitely a lot of questions. So I have a few that were sent to me, but
well, you want to do those?
Well, they wanted me to pose them. No, why don't you just go through these, and then I'll maybe interject these as we go. But there's probably more here than what you're going to have time to answer, but I'll just let you pick those as you want. Make sure you read the question off, though.
Yeah, I will. Yeah.
Okay.
The obvious question, are the chart definitions reviewed today available? Yes, they're available to anybody, not for just for premium members. Anybody can get our chart definitions from if you're talking about the chart definition of our market delta setup, no, they're not just for premium members. Anybody can get our chart definitions. If you're referring to the charts that we use today to explain the setups, yes, they will be available for everybody, not just for premium members. They will be on the site. The admin, I believe, or NJ, I don't know which, is doing is going to take all of those slides that I used in the presentation to explain the setups and is going to make those into one post, and it'll be in the educational section. You use a 6-tick point and figure chart for the ES Mini. How about other instruments like the Eurostoxx 50, oil, or gold currencies? You have to do it yourself, Ron. You have to size it to what allows you to see what you want to see. Now you know what you want to see. You want to see failure, and you want to see exhaustion, and I've defined how to see those. So what you need to do is whatever market you want to trade, play around with your point figures until it shows you what you want to show. What I would advise you to do is put up your market, put up a key level area that you were fading, that you knew was important, and then start playing around with the point and figure until it shows you what you want to see in the easiest possible way, and then you'll know you got it. Setting the stops is straightforward, just beyond the swing lows and highs. How do you set the target? Do you incorporate volatility? Yes, setting the stops is straightforward. It's generally just beyond the swing lows and highs. However, we do incorporate the market structure into that too. If you saw the second webinar, then you know that. If not, maybe you should go check it out again because that's in there. We're always adjusting stops and targets based on market structure. The targets are always based on high volume areas of acceptance or somewhere approximating that, or if we're kind of in an in-between spot, the target is going to be just inside what we think is the next rejection area. And then there's another time. Sometimes when we think that the market's really respecting the VWAP or pivots, sometimes we'll hop out before we run into pivots. Sometimes we'll hop out because we're seeing institutional selling pour in and we're on our way to our target and we don't think it's moving quickly enough. Like a great example would be in the in the trap setup. If we see that psychology that we're looking for stall, and then all of a sudden somebody's starting to pounding the bids with 100 lots, we're bailing. We're done. So we're always going to listen to the market. We're not going to do anything rigid. But basically speaking, it's going to be the nearest high volume area or the nearest just inside low volume area that's nearest to our trade entry. Can these setups work for end of day charts? Sure. There's no reason why you can't use these for swing or position trading. Absolutely. It's going to be a little tricky to find. You're not going to find trap setups on a daily footprint, I could tell you that. I don't know how far you could go up in terms of time frame, but again, you just have to experiment until you can no longer see it. You can't shortcut the work. You just got to put them up and just grind through a bunch of charts. That's what we do. In everything we do, in the algo company especially, we just grind, stare at charts over and over and over again until we see what we're looking for. And so yeah, put up your stuff. What does handicapping mean? Dennis left, but this is a great question. Handicapping means you are handicapping the levels for success, much like you would handicap your, you would handicap a game of some kind of, or like I don't know, like a football game or something. You're trying to figure out who you think is going to win, and you're basically, making odds on it, much like a bookmaker would do. Handicapping means that you want to figure out whether you think that your likely success is greater than a coin flip in all cases. In other words, do you think that you have an edge by trading that level in whichever direction you're wanting to trade it? And then what you want to do is further refine it by saying how much of an edge you think you have and coming up with your own method of deciding that, how you're going to process that in your mind. You were going to tell us how to set up bar statistics indicator to show institutional trades. Yeah. Oh, wait, I can't. Yeah, I'll tell you. This is the simplest way. And also, I think that Trevor has a video on this, but I could be wrong about that. Basically, what you want to do is have your footprint chart set up. Go into your footprint. Just double-click on your footprint and set up a separate footprint chart for only to draw footprints of whatever you want, 50 lots or higher, 100 lots. There's a filter in there that says volume filter, greater than, whatever. So put like greater than 100, and then you have that footprint chart set up. Now, when you open a footprint bar statistics indicator, you then make sure that you associate that indicator with the instrument, which in this case would be the ES, that has the 100-lot filter on it. So typically your chart, your entry chart, will have a regular ES and then an ES with a 100-lot filter, and then you will add an indicator to the regular ES that doesn't have, the filter. So the bar statistics are showing everything from that whole market, and then you add a bar statistics to the filtered one, so all the bar statistics are relative to only 100 lots. Okay.
Rob, by the way, I just posted a link to everybody. The link describes what he just said. I know that was a mouthful, and that just follow those steps, and you'll be fine. Right.
Fantastic. Can you clarify up versus down tick plotting? You contrast this with a slightly different type. Yeah. Again, that's in your, when you go into your footprint setup, again, double-click your footprint, and you're going to see that you have something called footprint display and footprint data, I believe. There's two tabs. You're going to notice that in one of those tabs you can choose whether you want the calculation to be on ask versus bid, in other words, that or the up versus down tick. They're really similar. I mean, I almost wish I didn't mention it, but if people want to poking around our charts and seeing that it's set to up versus down tick. All it is it's the bid versus ask on the either side of the ladder. Instead of ask versus bid, the trade's actually being placed at those. The trades are actually tracking based on market orders hitting the uptick or the downtick. It's very similar. Do you use time and sales to help with order flow? Yeah, I look at the tape. I can't explain to you how I look at the tape because I'm old school about it because I used to only use the tape in the dome. But yeah, I'm looking for bursts of size. I have some tapes set to different things, 10 lots and higher, 100 lots and higher. And I'm just looking for the speed of the prints to change, and that just dovetails into watching the exhaustion setup and the failure setup. Yeah, sorry, Maxime. Maxime's asking, you said you're using market internals. Which one are you using and how do you interpret them? I really can't go into the details on this. It's so brutal to even think about trying to explain this stuff. We use the S&P Premium. We use the tick, S&P ticks, not the NYSE ticks. We use the Ticky, which is the Dow ticks and the 30 Dow stocks. We use Delta Momentum, and we use cumulative ticks, and we look at the advancing versus declining volume, and we look at the VIX. And mostly it's for directional stuff. I'm looking for the cash market to be displaying that it is leading or lagging the futures. That's it. There's nothing else to it. There's no system to it. There's no nothing. And I also look at a bunch of sectors. I look at 15 different sectors plus the cash index plus all of the. I'm very interested in the bonds. I'll tell you. Very interested in fixed income, especially the 10-year right now. There have been a lot of. I'll throw you guys one. I'll throw you one bone here. look at the because it's just. I mean, I'm sorry, but it's just hard for me to talk about this stuff because it gets so involved. But you should definitely be looking at the euro against the S&P. It's very important right now. Currency's driving everything, and the whole world's scared to death of that and fixed income. And you really need to pay attention to the euro because the S&P is really paying attention to the euro. It's very correlated with the euro, and also fixed income. There has been a ton of hedge funds in a curve trade. They've been long 2-year bonds and short 10s. And that's all changing now. The 10s are getting a bid, flight to quality, everything's changing. So really, when they're bidding up the 10-year, it's an inverse relationship with the S&P. You should be paying attention to that. The VIX, same thing. VIX is inversely correlated with the S&P, like anywhere from 80 to 90% of the time. So it does lead. Option traders, implied volatility, put in moves, and that tends to track well in the VIX. You can see different things. So. Same thing with the ticks. Cumulative ticks just tells you the general direction of the market, and if the ticks are really extreme and that's occurring during one of these setups, again, we're just promoting independence. Just think about all these things from common sense, and it'll make sense. I mean, you won't even have to ask. You'll just kind of know that, you've got these setups, the order flow, and it's all kind of working together, and it's like, wow, you're looking for clues with this stuff that something is changing. You've already made your decision. You've already made your decision of what you want to do pre-market. You know what you're after. So all you're looking for is that nothing's going to change and run you over. You're not using internals to go, oh, well, the internals are doing this, now I'm going to trade. It's just the opposite. You're going to trade unless the internals are telling you something to the contrary, which, again, is obvious. I mean, if you're looking to get long and you look up and they're pounding the cash market down, well, maybe it's not a good time to get long, right? Really simple. Keep it simple. Trevor, these are the best webinars I've attended in 3 years. No offense, yours are good. So,
yeah, I saw that one. That's good.
Yeah, that's a little brutal.
No, I'm glad to hear that. That's what we want.
Can we do away with the footprint chart by replacing it with volume breakdown study coupled with candlestick chart? Not in my world, Raj. Wouldn't want to do that. Volume breakdown.
You really couldn't because you'd lose that intra-bar transparency that all those trades that you were looking at, you wouldn't have that information.
Right. Exactly.
But
And that's something, I mean, the volume breakdown is a great indicator, but it's really something that you should use for a confirmation, just like we're using the footprint bar statistics. In fact, it is the footprint bar statistics. It's just not numerical. It's a graphical interpretation. So technically, you could set up the footprint bar statistics to track the same way we do with the institutional. You know, you set up an institutional pane and then, you know, apply a volume breakdown trade, you know, indicator just to those larger trades, and you'd essentially have the same thing. It would just be graphical. And that, sure, I mean, that would be great, but it's definitely not a replacement. Yeah, Blair, I'll explain one more time. The question is, can you explain why you're using a 25 by 6 point figure setup? Yeah, and again, this is something. We're doing it because we're trying to remove time from the equation. Time just is, it just turns things into mechanization instead of just transparently looking at the market and not having time decided for you. It says, oh, a minute's up, so I'm going to change this. You know, a minute's up, I'm going to change it again. What the reversal does, and the 6 is just something that we've settled in with this particular market and during the time that we trade with the current volatility. In fact, I think one of our members the other day, I think it might have been Stuart. Stuart, chime in if it was you. I think it was you. He was trading in the huge volatility stuff that happened in the giant sell-off. We weren't trading that day, but he was actively finding setups, and he had his point and figure set to 12, and that really pleased me to see that, because that's what we do. I mean, that's, you know, we adjust to volatility ourselves, and that's something you have to do. If the market starts, you know, getting really volatile and it's reversing all over the place, well, the 6 isn't any good anymore. If every time the market moves 6 ticks is the equivalent of it moving 2 ticks in a normal time, I mean, the 6 is no longer going to show you what you want. So you just kind of have to keep flexible that way. So that's why we use the point and figures, because it's only reversing when there is a reversal in the market. So it builds, you know, bigger bars that we're able to look in and see the activity without getting chopped up. So we can see those hard divisions where the volume drops off or the volume really swells up, and not having it all of a sudden disappear and go to a new bar, and then we're trying to add up volume between 3 one-minute bars or something, right? How relevant is tracking 100-lot trades, particularly with icebergs and algo trading? You know, Brian, algo trade, I mean, we are algo traders, so I kind of take, you know, I don't think that all of this stuff that somehow is trying to tell you that the market is different because of algo trading. It isn't different because of algo trading. It's just we have algos trading it instead of people, but it's still being traded on the same principles. A lot of stuff doesn't change. You still have a free market, is my point. So it doesn't matter if it's a bunch of computers fighting out price levels or it's a bunch of human beings. You're still going to have the same activity, and so you have key price levels where, you know, for example, if it's program trading or if it's arbitrage trading, whatever, it's not a mystery why they're doing it or why they're trading it at certain places. There's inefficiencies they're trying to capitalize on. They have numerical decisions that they're making, and so they're making it. In fact, it's a part of our program trading data is part of our setup work, and you know we have people, market maker friends on certain desks and stuff, and you know it's important to understand that world. I mean, to say that they just move the market around and nobody else can, you know, have anything to do with it is really not, you know, it really isn't like that. So from that sense, the 100 lots does matter. I mean, you know, because when you trade, when anybody puts in a trade of 100 lots, it's very rare that the 100 actually prints. You know, it's going to match up, you know, the queue of people, the buyers and sellers in the queue. So you'll get, you know, sometimes it'll fragment it, it'll separate it out. So sure, it isn't 100% accurate in that sense that, you know, you're really seeing a perfect thing when you're just tracking 100 lots. However, as a general rule of thumb, bigger sizes do equate to bigger traders, because even though the 100 lot may be fragmented, for the times that it isn't fragmented, you know, there's only certain traders that are putting in 100 lots, and they tend to be more advanced, and they tend to be institutional traders. So it is good for something. It isn't, but to answer your question, it isn't statistically significant, so don't really look at it that way. I know you guys are looking at Euro stocks for some of your trading. Have you done any studies on the best setups for the charts on this contract? Yeah, I mean, we've looked at the Euro stocks a lot. It's really just pretty correlated with the S&P. I mean, it trades a little bit more volume. Typically, the highest volume is during the cash market open for the S&P, so it's really the same time of the day. For us, it's really just a way for us to trade more money. I mean, we like it. It's a great contract, but again, it's just you can only shove so many contracts with 1 to 2 point trades into the S&P, and once you're trading more, it depends on volume times of day, but comfortably, anything over 500 is pushing it to make sure you get fills all the time whenever you want to trade, and you don't have a lot of slippage. So you can get a couple thousand off depending on what you do, but for us, it's just an easy way to keep the size a little bit smaller, the relative size in the trades, but just move off to another market. So I can't really get into specifics about the Euro stocks here, but it does have some correlative stuff with the S&P that you could look at too. Why ES preference over NQ? Well, because it's liquid. It's way more liquid. And and we like the influence of program trading and algorithmic trading and arbitrage trading, and there's more of everything in the ES, and the ES is the first stop for risk capital in the world, and it's we couldn't trade the size that we trade in the NQ, first of all, but certainly not for some of the new fund products that we're about to do. The NQ is okay now. It didn't used to be, because it used to be that it didn't have 4 ticks per point, so the spreads were terrible in that respect. But now they've solved that problem, so it's good, and it's pretty liquid. I think it trades what, 300,000-400,000 a day. So if you're a small trader, it's good. But stay in the ES. Trade against the best traders in the world, and and it's easier to. It's easier to track, I think, too. No, Michael. Michael said, are you saying the Euro's leading the ES right now rather than the 10-year? Difficult to know what's leading is it. Yeah, it's not about that. I mean, I'm not saying that I can tell you at any moment what's leading the ES, but I am telling you that if there is a lot of money that's either pouring into the bonds or pouring into the ES at certain times, and you're seeing a reaction in the 10-year, what's that telling you? It's telling you that money is moving from one to the other. Make no mistake, the ES is the parking lot for money that is not in a flight to quality mode or otherwise out of the risk game. That is what bonds are ruling everything. That's what's happening. So if money is coming out of the 10-year, it means that people have got a risk appetite, and the first place that they want to put it is in the ES. It's a parking lot. And at that point, they know that they're at least keeping pace. Institutional traders and equity traders in general, everything is about the value of the index. Nothing matters. In fact, we joke about it because here we are, creating algos that make spectacular returns, and a lot of those algos are used as overlay strategies for people who trade equities, and all they care about is beating the indexes. So everybody's like, hey, we have a client that literally brags about the fact that he only lost 19% in 2008. It's like a badge of honor because these guys are tracking the indexes, right? So that's the whole point. So the whole point with the 10-year and the euro, it's knowing that things that are influencing global money supply are moving, and that those are things that are being respected by the ES. It's not about leading, and you're right. I do not advise you to try to sit around and figure out what's leading what, because it's pointless. They're leading each other at different times. I mean, I look at the Russell, the NASDAQ, the S&P, and the Dow simultaneously, and I look at where they are relative to their pivots, relative to their overnight highs, lows, closes, yesterday's highs, lows, and key levels that they're trading on their profiles, and I'm just looking for when they're out of balance. I'm not going to try to figure out which one's leading which on any given day. Is network latency important to you? Yeah. It's very important. It's more important if you trade big size. We have servers on the floor, so our latency is about 4 milliseconds on our algo trading. Obviously, everybody's bound by the internet connection. When you're trading, discretionary trading doesn't matter. Even if you're accessing an internet connection and you're not sitting, next to your server on the floor trading, then then you have a disadvantage for sure. You should live here then. Craig must live in Chicago. Yeah, all of our algo trading is done from the floor. 900 milliseconds sometimes. I said 4 milliseconds.
Rob, I'll pose the one that I had actually I got a whole bunch, but I'm only going to be able to pose a few. One was on these types of trades that you covered today. Are you kind of all in, like you see the trade, you take it, or do you leg in, leg out? I know you've touched on some of this in the other webinars, but
yeah, no, we don't. Mathematically, legging in is disadvantaged, so we don't believe in scaling in. First of all, it doesn't matter anyway. It's a moot point because we're trading, for 1 to 2 points, and there's no point to leg into a 1 to 2 point trade. That's just our method. We're all in, all out when we trade the ES. That's just the way we do it. If you're trading for a longer term, I mean, I suppose legging in, could be okay, but you got to do things for your risk model with it. It's not easy. People take it for granted. They just leg in and they don't realize that they have to build a whole risk model around legging in. And I'm not going to go into that detail here of how to do that, but legging out is much more mathematically advantaged because you're averaging down your entry price as you go, and it's you're taking profit off and you're moving the line out with you instead of moving it against you. So that's the best answer to that. There's one more. There's another one that I was looking for here. Asking about our dedicated lines on the floor. I'm not going to get into all that stuff, Dave. Are you talking stocks versus futures? I don't know.
I think you've gotten most of them. I know it's hard to get. There's so many here. It's hard to read, and you may have skipped a few.
I think I got them. Trying to scroll and see if I missed anything at the beginning, but 2 sets of filter time. I already talked about that. Yeah, I think we got it. Didn't we get both? I think we got most of them, huh?
I think so.
Good. Oh wait, is there a couple others coming? What's the big lot setting for Dow Mini? I don't know. I have no idea, Raj. No reason to trade the Dow. You know what? This brings up a point, and I don't know if this is if this is what you're going on, but a lot of you, I see this a lot. People ask us this a lot, and I think I should clarify this. A lot of people, I don't know who's saying this or who's been educating to this, but it seems like a method, something that's running through everybody, a lot of small lot traders, and that is that they're trading the Dow because they think it's an easier contract to trade than the S&P, or it's better suited to small traders because there's less competition from program trading or arbitrage or algo stuff or whatever. I would caution everybody against that. I don't see any reason to trade the Dow. I mean, it's not as liquid as the S&P. Number one, so especially if you start trading a little bit more size than one lots. I mean, you've got issues when you start getting up to any significant size. But more importantly, it's generally when you have less volume, you have more predatory activity, not less. So, when one of the nice things about the S&P being so huge and so transparent is that it's very difficult to move the market around. So it tends to respect levels very well. You know, it's noisy, but again, your winning versus losing is based on handicapping the levels, like I've been saying all along. So, you know, you're putting yourself in a better place to win if you're a contrarian trader trading the S&P than you are trading the Dow. Just think about the S&P during lunchtime when the volume drops off and how easy it is to move the market around with with very little relative size compared to what you are seeing in the S&P. So it's really something that you should consider. You know, and also there's a lot of stuff about, you know, does the Dow trend trade better or trend better than the S&P? You know, I think it does. I mean, in terms of the pullbacks and the cleanness of them and all that. And obviously the spreads are really good at having 10 ticks to a relative point is a good thing. But it's you know, I again, like indexes in general, equity indexes to me are just not a good place to trend trade. I mean, if you really want to utilize market delta, utilize reading the order flow, trend trading isn't really, you really can't get much from the order flow, you know, in a trend capacity. You get way more efficiency out of trading the footprint chart using a contrarian approach, and it's just better suited to it. The S&P is just better suited. David, I'm not going to tell you who we clear with and what our rate is. And I'm not going to tell you what our member margins are. When scalping with these methods, how many trades a day are typical? We take one trade a day typically. Scalping, if you're talking about scalping, and then again, I don't know if your nomenclature is right, Rod, but scalping to us is pure scalping. That means scalping for ticks. Trading for 1 point is not scalping. That's kind of something on the internet. You know, people say, do you scalp the S&P? And they go, yeah, and they say they trade for 1 point. That's not scalping. Scalping is scalping for ticks. So scalping, you know, we just kind of scalp till we're tired, I guess. I mean, around levels, if we're tick scalping levels, we just, you know, we trade the volatility around the level, nothing else. There's no setup. It's just a timing thing and watching the quality of the prints. And it's beyond the scope of the blog. Like I said, we're not going to get into the, you know, teaching people how to scalp on the blog. We still have the time or the inclination. This is just, you know, these order flow based setups, picking the levels, basically our standard stuff that we're doing is what we're showing on the blog. But other than scalping, you know, our regular trades, we take one trade a day per account. That's what we do. We're using that as a way to design the risk model. And again, make sure you see the first 2 webinars because that's, you know, there's a lot of information on that and developing your risk and doing it correctly. So definitely check that out. Oh, coin flip. Somebody developed a model using a coin flip 50-50 and time every 5 minutes a trade. I had like a 70% win rate. Yeah, exactly. See, Tom, that's exactly what I was telling you in the other webinar. If you do that, you teach yourself, and I hope that you're walking away with this and feeling good about it. You know, you develop a model, you flip a coin 50-50, and now you're seeing that you can win 70% just from picking some little thing on a 5-minute chart. That's what we're advocating. You know, get your confidence from your risk model. Understand that if you're really designing a risk model that limits the number of trades, you have a binary event, you're either going to win or lose a level, you start to understand that the market's not out to get you. It's the people that have trouble trading are the people that overly complicate this stuff. I mean, it really isn't complicated. You just have to stick to your guns and do it, and it really is easy. What's funny is the people telling you that it's easy are not giving you easy ways to do it. Those are the guys that are always telling people that they need a system and there's complicated method and there's all this math involved and they're running through this indicator and they'll tell you. You know, that's the clue right there. I mean, you should get it from just the coin flip itself and realizing that you have basically an equal number of participants in this market and they're all got different opinions and they're trading in different time frames with different time horizons for how long they want to be in the trade, if they're working a position or if they're swing trading or if they're day trading or if they're scalping. And everybody fights over these levels. Somebody wins, somebody loses. That's what's going on at every single level that you're trading. It's really that simple. So you just have to have a way to segment it out and say, this is what I'm going to do. I'm going to take this event. This is what I think. I'm going to follow my own advice. I'm going to manage the order flow when it comes. If it sets up the way that I want it, it's good. I'm going to take it. And you know what? You're just going to win. I mean, as long as you have good ability to handicap the levels, that's the most important part. And spot danger. You know, use the footprint, use the transparency to spot trouble. You know, look at things, notice the correlated markets, and notice the internals, and notice when things are not going your way. You know, and don't go out at your full stop. You know, just say uncle and go out with a couple ticks profit or even or something. Couple other questions. RG, did you start as a prop trader and then grow into managed accounts? No, I didn't. I mean, I started trading my own money about 1 billion years ago. And I got into the business by somebody being really enamored with my personal trading and my success. And it was a small hedge fund who subsequently I started working with, doing some algorithmic work with, and we built the algo companies on the back of that. In fact, that's how I met NJ. NJ was a programmer and a trader who we hired to do some work for that fund, and we, NJ and I ended up starting this algorithmic company, and we brought on a whole bunch of new clients, and we really went from that. And then all along, you know, we were trading the ES, and that's how we got. And we're not into managed accounts at all. We don't manage any money in the sense that in a fund product. We have a relationship with an offshore group. I'll just leave it at that, so not to give away anything about it. And we are building algo strategies for that particular company, and that company has also developed an interest in some more of this intraday stuff and some of our LLC accounts that we have, and wanting to expand those into offshore fund products, but they are not, as of now, they're not offshore fund products. They maybe will be, so that, you know, we're really in the algo business. So our clients are, you know, our clients are the institutions and the other funds that we build trading strategies for. And this discretionary strategy is one that everybody wants, right? Because we have the high returns, and it's, you know, everybody loves the idea of it. And we've just resisted doing it because it doesn't make any sense to us. I mean, we're looking at it going, you know, well, if you could trade, you know, X money and you could trade X contracts, you could shove them through. I mean, why not keep all the money? I mean, what's the point of having a fund, you know, where you're going to, you know, what are you going to trade in the fund? You trade a few $1 million, and, you know, you're going to, you know, be at 2 and 25 or 30 or 33 or whatever, and then, you know, and then, so you're only keeping a third of the money. I mean, it doesn't make any sense to us. So that's why we haven't really pursued, you know, doing fun stuff with this, because it just doesn't make any sense to us financially. We'd rather just continue to tier out markets and strategies within the same vein and just trade more and more of our money or partnership, you know, money or whatever within our little crew. So hopefully that answers the question. And this dovetails into another question somebody was asking. Do you, you know, let's see if I can find that question. Somebody was asking me whether we are soliciting money or trying to bring in money to trade, or, you know, trading money for outside accounts. No, and in fact, we, you know, even outside of the blog, I mean, we've made it really clear that we don't want to merge those two worlds, and we never have. But even more so, you know, our intraday trading is not something that we want. We don't want anybody's money. I mean, like I just explained. So that's it. And any of the other stuff, we have our hands full with the algo business. So we and all that stuff is fee-based stuff. So you know, we're working with some pretty high-profile clients, and hopefully some more really big ones coming now soon. So the business is really growing for us, and we have our hands full with that, really. And you know what? It's as close as we want to get to clients. Honestly, we started, you know, the algo business in a way to get away from the idea of clients. I mean, I have a lot of friends in the business, a lot of friends that are managing money, and you know what? Clients are a pain. I mean, I don't know why they do it. I mean, it just seems like, man, you have to give me a lot of money, and then I just, you know, so I say, okay, well, great. What's my path? Am I going to, you know, start a fund group and go, you know, as a CTA and go raise $1 billion? I mean, I'd kill myself. And it's ridiculous, you know, because we get the same path and make the same money by, you know, doing overlay strategies for equity clients and you know, and trading, you know, our own private LLC money with the S&P. So anyway, hopefully that answers your question. That was Marlene. Yeah, I can count on you. She says I sound old, but she put a smiley face next to it, so that's good. No, we don't. We are our own prop firm, Marlene. We're not in a prop firm. We never trade in a prop firm. No, absolutely not. This is all my stuff, or our stuff, I should say, that NJ and I have created. Do you trade outside exchange 4 hours? No, but only for liquidity reasons. You trade size. If you want to get all your contracts on and off, you trade in the first hour, basically. And some days, we can't even do that because the volume's light and you can't get all your stuff on without a lot of slippage. So we have models for that, and we know when volume's too light to trade, and we have to adjust our size during that time. Have you tried contrarian trading with currency futures? If so, how does it compare to the ES? We've looked at it. We have a lot of algo stuff that is trend and mean reversion based, and I can tell you that contrarian trading in the currency futures is not particularly, advised. Maybe you could do news contrarian trading in the currency, but that's beyond my experience. If anything, I would think that might work, Lloyd. But the currency. If you're in a trend trade, and again, I'll reiterate this because we haven't got the direct question, but if you're going to be a trend trader, don't trade equity indexes. It's the worst thing to trend trade. It really is. I mean, and I'm not just saying that because I have an opinion. I am. I'm saying that we've studied this stuff in great detail. I mean, we have looked at all of these markets from a trend perspective, from a mean reversion perspective, futures markets, I mean, in the greatest detail that you can possibly imagine. The equity indexes are terrible for making money with trends. They're noisy, they're jumpy, they're just terrible for that. Currency futures are good for trending, and softs are great. Obviously cocoa, sugar, coffee, corn, wheat, soybeans, the agricultural stuff, all good, plenty of liquidity. In fact, fixed income, if you want to know the truth, fixed income, as I said in the last webinar, is this, with our group of trend following models, is the single biggest moneymaker in all of the models for trend-wise. And when I'm saying trending, I'm not talking about necessarily intraday, but anything from 3 days out to months. Nothing has made more money in the last 20 years than fixed income in the trend sense. So just if you want to, personally, I think that the contrarian trading is so superior for the day trader anyway. I don't know why anybody would trend trade intraday, honestly. I mean, unless it's just you've got this thing where you feel like you're missing the move if you're not catching the trend or whatever, and then everybody goes around going, the trend's your friend, the trend's your friend. Ask NJ. Write him sometime and tell him what I think of trends. I mean, outside of intraday, I love them. I mean, it's our bread and butter. That's our whole algo company, really, is trend models. And yeah, they do trend hard at times, Tom, but not enough to be interesting to me in the sense of handicapping price levels and being able to trade with less risk, which is everything. The reason that we're contrarian traders is because of risk. We're contrarian traders because of risk, because of handicapping, and in every way it's superior to trend trading intraday. It's not even, I mean, I could show you miles of research and math to prove that. It's just not even remotely a contest. It really isn't. And if you make money trend trading, I'm happy for you. Believe me, so do we. Okay, we just don't do it intraday. And if you found a way to trend trade intraday and you make a bunch of money, you know what? Write me and tell me how you do it. Because if you can show me that you can minimize my risk less than that, then who knows? Maybe you can be our partner someday because you're probably a genius. I mean, seriously. I mean, I'm kind of being sarcastic, but really not. I mean, I really, where you need to put your stops. It's just where do you trade trends? Do you trade breakouts? Trade pullbacks? How does it set up? You always got to have more risk. You're initiating the trade. It's all on you. You don't get to react to other people's psychologies. You just lose all the advantage to me intraday by trend trading. But that's just my opinion. The Forex, yeah, the FX is I would personally trade Forex, but because I feel that the market is corrupt. And especially if you trade size, and if you have a relationship with a bank, is a different story. But the Forex, the spot market, is a whole different animal. Personally, if I were trading currencies, I would just trade currency futures. I mean, we do. We build trend following algos for multi-markets that include the currencies, and we deal with certain people who are very big systematic trend followers that are very well known in the business, and none of them, hardly any of them, trade forex. I mean, some of them trade a little bit, some of them, for certain things, but basically speaking, they're trading currency futures, and they're just, packing billions and billions into those markets, and it's fine. So, I don't, forex with the spreads and all that stuff, I don't know. It just doesn't make sense to me. But you know what? I should shut up because it's kind of beyond my experience. I don't really have a lot of experience with forex. It just seems like the Wild West to me. I like exchange products. I like to know exactly what the spread is. I like to know exactly what the cost is. And I like to know that I'm only trading against other players and I'm not trading against the house. It's just like Vegas. If I'm going to go play a game, I want to make sure I have an edge, and I'm not going to play it against the house unless I have an edge. Otherwise, I'm only going to play against other players, which means that you're likely to see me at the poker table and nowhere else unless I have an edge, right? So there was one other question that I saw here. Oh, Marlene, yeah, I said it was a billion years. Yeah, I'm not a billion years old. I'm a terrible exaggerator. David Young, so what are you offering? We're not offering anything. We're not soliciting money. We're not doing anything. I don't know if you saw it. You probably didn't see the first two webinars. We are, we had a blog that we put up for ourselves for our own benefit, and we decided to make it public as a way of sharing and finding if we found that the same process would be expanded by sharing with other people, which it has, and we're really enjoying it. And so we're not offering anything other than just a forum for everybody to come and kind of see the way we trade and maybe benefit from our information in some way, study it and learn from it if you're so inclined. And for a certain limited group of people, we've allowed them to see our stuff prior to the market open, and so we have a limited membership where they can pay a nominal fee and get the stuff ahead of time. But that really is, that's the small commercial element of the blog, but it really has very little to do with it. Do we sell our research? No, Tom, we don't. We don't. It's only for us, and we sell it to our clients. And it just wouldn't be practical for smaller traders. Our stuff is fee-based on what it ends up being placed in, so it just wouldn't be practical from a financial standpoint for small traders for us to sell you our research. I know there was one thing that I missed. Contrarian, same as responsive trading, yes. Responsive, opposite of initiative to trade in market profile terms. Yes, Alex, that's what I mean when I say contrarian. We're looking for a response to a price area that has previously not traded a lot of volume. And again, that's the stuff that's in the second webinar and is absolutely critical to this and doing the order flow analysis on top of these key levels. Very important. So please check out that second webinar. The Mousetrap Setup, can it be used on a range chart? Is it still effective? Yeah, I think it can. In fact, I think NJ has done a little bit of it on a range chart, if I'm not mistaken. And you could, Josie, ask NJ about that because he might have some insight in that because I know that he's used range charts before. I haven't. Do you share your algos? No, we don't. We just they're all proprietary, and that's what we don't share. We're sharing all we can here, just our interpretation of discretionary ES trading. So, you see anything else, Trevor?
No, I mean I think you got most of them here.
What is our risk reward in ES? 1-to-1 or better, always. 1-to-1 or better. And obviously, that's up to you. You need to design your own risk reward that works for your style of trading. We like to win a lot of trades, so 1-to-1 is our line in the stand. I mean, some guys won't trade except 2-to-1. If I were trading for 3 or 4 handles, it would be 2-to-1 or more. I mean, you have to set it to the style that you trade in. And if you're trading for like a point and a half, something like that, 1-to-1 is good if you're trading these types of contrarian setups. I think it'll be good. Anything else, guys? Anything real pertinent before we sign off? Can we buy you a beer if we bump into you anywhere after giving us all your info for free? Yeah, you can buy me a beer if you want to, Jonathan. I'll take it. So hopefully, look, I mean, just to wrap up, you know, again, we don't have any expectation about this. We're really enjoying the process. I guess you could say maybe we're giving back. I mean, whatever you want to call it. You know, it just kind of evolved. We developed a great relationship with Trevor, and I can't say enough about him. And again, we're not, you know, it's not like we're paid endorsers of Market Delta or whatever. It's not like that at all. I mean, we just really like the software, and we got to know him from using it, and we made the switch from using the Dome, and you know, we just started talking about trading, and you know how I was noticing just from going through, looking at his videos and kind of getting up to speed, and then that got me on the internet, and then I was looking at other posts and kind of seeing what was going on a little bit with retail, and Trevor and I started talking about retail traders, and it just sort of evolved, and I had said that we were doing this, sharing with each other and enjoying it, and wouldn't it be interesting if we were sharing with retail guys and seeing what would happen, and it just, he said, well, maybe we should sponsor some webinars, and it just kind of evolved, and we're just, we're enjoying it. I mean, the blog is, don't forget, guys, the blog is ours. I mean, we would have that blog, our partnerships are kind of spread out, so we have some traders in different cities, so the whole point of the blog was to have a place to upload stuff so that we could all share it really easily, and then we all get on Skype and talk throughout the trading session. So it's just something that we were going to have for ourselves, that we just kind of slapped a logo on it and called it Discovery Trading Group and kind of made it public. But you really shouldn't think of it that way. It's really, it's not a commercial thing. It's not anything about that. I mean, we just responded to the commercial request of everybody, really just saying, please, please, please let us have the stuff pre-market. And, we agreed to do it on a limited basis. As I say, I'm putting my toe in the water to see, as long as it's not a problem. And again, I'm not worried about being front run. This is stuff that's just, basic stuff. I firmly believe everything that I said. We're all contesting these levels. We have traders at different time frames. Even if everybody has the information, they're not going to be able to duplicate exactly what we're going to do right down to every second, nor would they want to. I mean, trading doesn't work like that, discretionary trading. Now, if we had something that was edged down to the tick and it was a mathematical thing, which we do, we have many algos like that, we don't share them to anybody. We never would, because those are the types of things that can be taken advantage of, and the edge can be taken away. But so we're not worried about that. We just don't want to feel like our stuff that we're giving away is being taken advantage of. And by not just blasting the stuff to everybody and letting everybody have this information, we can control it a little bit. And like I said, I don't want to see it up on forums and people passing the stuff around every chat room and taking for granted the fact that we're giving you our whole playbook every day. And I think it's fair to say that we're really going beyond what most people would do in doing that. And whatever. I believe what comes around goes around, and people are enjoying this for the right reasons, and that really makes me happy that everybody's disarmed. And Trevor was talking about that too, that we're not here like shoving some indicator package down your throat and buy this and buy this and buy this. And, we just want to see you guys interact and enjoy it. And I tell you, a big motivation for it is going on some of these forums. I'd never been on them before because I just never really did the retail trader thing. And I went on these forums, and I can't even believe the negativity. I mean, it's just like every post is, you can't make money from that. Scalping, you can't make money from scalping unless you have, commissions of, 2 cents a side and a computer run it, and there's no possible way to scalp for ticks. It's impossible. The algos ruin all your trade. Just lies. I mean, like, they have no idea what they're talking about, and they're like 1 and 2 lot traders, and they're in there jamming those forums with negativity. And it's just, if that's all there is to go to, I mean, I feel for you guys. So hopefully, we're just trying to have a place where, you guys will come back and not even for us. Like I already told you, our time's limited. We're only going to interact on a limited basis. We don't have a lot of time. But if all of you guys that learn from this stuff end up, interacting, and then you got Market Delta and their forums and then their, their knowledge base and everything that's there. And I mean, I just have this vision of the, the people who really get it, about intraday trading kind of, congregating in one place that isn't negative, and that people aren't saying what they can't do, and actually hearing from people that not only say that you can do it, that are doing it. And it isn't, and then again, hopefully you're seeing, by seeing all of these webinars together, you're seeing that hopefully you're going, wow, this is like really simple. These are guys that are really doing it, and it's simple. It isn't complicated. It's just the market as it is, fights at different price levels just like you would think, and you got to make a bet, and hopefully you win. And even if you don't win, if your risk model is right, you're not going to get crushed. The market's not out to get you. That's really, that's it in a nutshell. And so hopefully we're getting through to you guys, and you're seeing that, and we wish you all the success in the world. I mean, we hope we hope you have success, and you know what? And if you're making mistakes, we're still trading against you every day. So you know what? If you're one of those guys that is still obsessed about trading that breakout, and now you know what we're looking for. But you know what? If I see that and you're setting up and you're down there in that group, well, I'm getting your stop too, there, brother. So it is what it is. Everybody's that's what we're all doing it, right? We're all trading against each other every day, but it's we're just trying to make for something that's a little less negative and focuses on the positive. So anyway, right, the micro providers of market liquidity. That's what we all are. Even us. We're not, in the grand scheme of things, Alex. We're micro too. We're certainly not moving the markets. So you'd be surprised what size it takes to move the markets. So that's it, I guess. Anything else real quick? I'll answer one more question. Anything that's pertinent? No? All right, looks like that's it, Trevor.
All right, very well said on everything, especially those last comments on the negativity, and you're so right on that. It's just so right. If you haven't been beat up in the markets, go visit the forum and make a post, and let them come after you. Just doesn't do much. Doesn't do much to help your self-confidence.
No,
I'm going to just wind this down real quick. I want to show everybody, because I know there's quite a few that weren't there. You've seen his screens, but you may not have the software. I just want to show you where you can get a trial and get signed up for that. You should be seeing my web browser. He showed where you can download his charts. So you can get their charts right on their blog. Here's the link. I'll post this out to everybody. And you can download these charts and import them right into your Market Delta. But in order to get Market Delta, just go to Products and Trial Form, and really just check this page out. You'll have to have one of these data vendors. I know we've gone long today, and I don't want to get into all this. It's all self-explanatory, but you just need to get to this page and fill it out, and you'll have the software that he's showing. And then we're here, of course, to answer any questions and help out when it comes to that, any technical issues or anything like that. One other thing, this is more on a light side of things, but if you go to our blog, I just posted a video of the crash last Thursday. It's only 10 minutes, but it's fascinating. You should check this out. It's a footprint chart with some audio commentary from Ben Lichtenstein, who basically is quoting the pit, and it's a very interesting watch. It might reinforce some of this stuff, it might not, but if nothing else, it's great to check out. And then under support, just clicking support, you can get into our knowledge base, which has the video library and all that kind of stuff. So make good use of that, and we really appreciate everybody making use of these and attending. We've had great feedback, so Rob, we really appreciate that. All your efforts there.
We really enjoyed it, so we appreciate you hosting us, and it's really been great. We really have had fun, and hopefully we'll keep it going, and we'll do some more stuff. I mean, I don't know where we go from here, but
yeah, we can talk.
What happens here, and we'll see what happens.
This has been recorded. You'll get a link tomorrow, probably in an email. They're also up on our blog, so you can always just come back. I'm recommending you download them because they're large, and so it's going to be best if you download them than watch them. But look for an email or check our blog tomorrow. Rob, I'll get these all to you as well. And that's it. Thanks, everybody. Thanks, Rob, and talk to you all soon.